Yeah, it's a kind of a weird thing, but I think most folks will probably understand. The slide here is I'll try to be succinct in some ways here, but this is a long-term grid from about 2008 that shows profitability on a per loan basis for our independent mortgage bankers. So the real key quick thing to look at is really the blue lines. That's profits per loan. So you can kind of look at it and say, wow, okay, it's kind of been up and down. There's the straight line is 56 basis points per loan has been our profitability, our average profitability over that period. So you can kind of look at this and say, okay, wow, what is that, huge increase in the blue? And you can think about what that is. That's the second quarter of 2020. So what happened in the second quarter of 2020? Well, COVID hit, right? Initially we thought everybody was going to start closing down and everything, and rates went really, really south, so everybody wanted to refinance. So what happened? Everybody wanted to refinance, so we didn't add any staff immediately. So our profits went up very, very quickly on a per loan basis. That's what you see, that 167 to 203, it just shot up really, really fast. And then, the reality was we realized, I think everybody realized, that this refinance wave was not going to be a short-term thing. It was going to go on for a long time. And so what ended up happening was we started to add employees, right? Because you just can't keep running people to death. So the profitability went up really fast because we, frankly, had a lot more business trying to do it with the same number of employees. Eventually, that's not sustainable. So what ends up happening, you hire folks, right? So your costs go up, and over time, that per loan profit goes down. So I'm going to slide to a next slide here, and I'm supposed to give it a second, but did a double jump. Oh, no, there we go. Okay, so what ended up happening, so this is on a per loan cost. So if you look at this, and I know this is a lot, and hopefully you all can see it, but what happened in the second quarter of 2020, what we're talking about right at the beginning of COVID, our cost per loan actually went down. That's, think about it. We didn't add anybody, we just said work harder, right, initially. So cost per loan, the expenses went down. But eventually that started to go up because it's just not sustainable. And so you can see what's happened is costs have gone up and up and up. So now we're at a point where it's $9,500 a loan in the last quarter we reported. So quite a good increase. So why did it go up so much? Well, I want to go back and see if we can revert back to the previous one. There we go. So we'll go back. So you can see in the last couple of quarters, profits per loan have gone drastically down. So what's happened? Volume fell off a cliff. Frankly, we still had the same number of employees in place. So the profits per loan have dropped dramatically. You can actually see in the last quarter we reported here, the profits per loan are actually below our long-term trend, well, long-term, last 12, 13 years. So you're kind of seeing some interesting numbers here.
Right, it's a bit of a whiplash effect on both sides, where I remember a lot of companies had a hiring freeze when the pandemic started, and then all of a sudden people were looking to dramatically increase headcount to cover the increased volume, and now we're seeing the reverse of that. Yeah,
it's kind of an interesting thing when you look at it. It's for those of you who've been in the industry a long time, this is kind of the extreme part was atypical, but generally speaking, when we have the refi booms, the refi waves, traditionally in the initial part, costs don't go up as quickly, so it's going to be a little more profitable. And then it's going to invert on the backside, right? Your costs don't drop as quickly, so your profitability drops fairly quickly as those waves end.